Question 1. Which of the following statements best describes the primary difference between facultative reinsurance and treaty reinsurance? A. Facultative reinsurance applies to all types of risks, while treaty reinsurance is specific to individual contracts. B. Facultative reinsurance involves a case-by-case agreement between the ceding insurer and reinsurer, while treaty reinsurance is an agreement that covers a set of risks under specific terms. C. Treaty reinsurance involves the ceding insurer assuming the risk, while facultative reinsurance has the reinsurer all risks. D. Facultative reinsurance is only applicable to large insurers, while treaty reinsurance applies to smaller insurers. Answer. B. Explanation. Facultative reinsurance is arranged on a case-by-case basis where a reinsurer and ceding insurer agree on the terms for specific risks. This differs from treaty reinsurance, which covers a broader set of risks under a predetermined agreement. The purpose of facultative reinsurance is to handle unusual or high-risk situations individually, while treaty reinsurance provides more predictable coverage for a portfolio of risks. This distinction helps insurers manage their portfolios effectively, balancing both predictable and non-predictable risks. Question 2. Mr. Mitchell, an insurance company underwriter, is reviewing a reinsurance contract that includes a quota share agreement. This agreement stipulates that for every $1,000 of premium collected, 40% will be ceded to the reinsurer. If the total premium income from a given portfolio is $5,000, what amount of premium will Mr. Mitchell retain, and how much will be ceded to the reinsurer? A. Mr. Mitchell retains $3,000 and cedes $2,000. B. Mr. Mitchell retains $2,000 and cedes $3,000. C. Mr. Mitchell retains $4,000 and cedes $1,000. D. Mr. Mitchell retains $1,000 and cedes $4,000. Answer. A. Explanation. A quota share agreement is a proportional reinsurance arrangement where a fixed percentage of premiums and losses is shared between the ceding insurer and the reinsurer. In this case, the ceding insurer retains 60% of the premium income and the reinsurer receives 40%. Given the total premium of $5,000, Mr. Mitchell will retain 60% of $5,000, which equals $3,000, and cede 40% or $2,000 to the reinsurer. This arrangement spreads both the premiums and risks proportionally based on the agreed-upon percentage. Question 3. Scenario-based. Mr. Thompson works for a reinsurer that has entered into an excessive loss reinsurance agreement with a ceding insurer. The agreement stipulates that the reinsurer will cover any losses that exceed $100,000 up to a maximum of $500,000. After a catastrophe, the ceding insurer reports a loss of $350,000. What amount of the loss will the reinsurer cover? A. $350,000. B. $250,000. C. $450,000. D. $500,000. Answer. B. Explanation. An excessive loss reinsurance agreement is a non-proportional reinsurance arrangement where the reinsurer only covers losses exceeding a certain threshold known as the attachment point. In this case, the threshold is $100,000. Since the ceding insurer's loss is $350,000, the reinsurer will cover the amount that exceeds $100,000, which is $350,000. 100,000 equals $250,000. The reinsurer's liability is capped at $500,000, but in this case, the loss is only $350,000, so the reinsurer will cover $250,000. This reinsurance arrangement allows the ceding insurer to manage large, unexpected losses while limiting the reinsurer's exposure to catastrophic events. Question 4. Which of the following is a characteristic feature of a stop-loss reinsurance agreement? A. It covers only claims that exceed a certain loss ratio. B. It provides coverage for specific high-severity risks on a case-by-case basis. C. It pays out only after the ceding insurer has exceeded a specific loss threshold for the entire portfolio. D. It is limited to covering a percentage of premiums collected by the insurer. Answer. C. Explanation. A stop-loss reinsurance agreement is a form of non-proportional reinsurance where the reinsurer covers losses that exceed a specified aggregate threshold, often based on the overall loss ratio for the insurer's portfolio. Once the ceding insurer's total losses reach a certain point, the reinsurer steps in to cover further losses up to limit. This helps protect insurers from catastrophic losses that exceed certain, providing financial stability. Unlike facultative reinsurance, which is negotiated case by case, Stop loss is based on cumulative losses over defined period. Question 5. Mr. Harris is an underwriter who is assessing a treaty reinsurance agreement that includes a clause for loss ratio pricing. This method is based on the historical loss ratio of the ceding insurer. What impact does high loss ratio have on the reinsurance pricing for the upcoming year? A. The reinsurance premium will likely decrease as the reinsurer assumes higher risks. B. The reinsurance premium will likely increase as the reinsurer adjusts for higher claims experience. C. The reinsurance premium will remain unaffected as the pricing is based solely on premiums written. D. The reinsurance premium will be renegotiated annually with no impact from the loss ratio. Answer B. Explanation. Loss ratio pricing is a method used to determine reinsurance premiums based on the ratio of claims to premiums collected by the ceding insurer. If the ceding insurer has experienced a high loss ratio, indicates higher than expected claims, suggesting that the risks being ceded to the reinsurer are also higher. As a result, the reinsurer will likely increase the premium for the next period to compensate for the higher future claims. Loss ratio pricing is a reflection of past performance and helps adjust for the insurer's risk profile. Question 6. Which of the following statements about retrocession is correct? A. Retrocession is the process of a reinsurer passing on a portion of its risk to another reinsurer. B. Retrocession agreements are exclusively used for treaty reinsurance. C. Retrocession agreements only cover proportional reinsurance risks. D. Retrocession is illegal under most jurisdictions due to its complexity. Answer A. Explanation. Retrocession is the process by which a reinsurer transfers part of the risk it has assumed from a ceding insurer to another reinsurer. This is done to further spread risk and manage capital requirements. Retrocession is typically used by larger reinsurers to limit their exposure to significant losses and diversify their risk portfolio. It is not limited to treaty reinsurance nor restricted to proportional agreements. It's highly legal within the framework of reinsurance practices across most jurisdictions. Question 7. Mr. Peterson, a claims adjuster at a reinsurance company, is handling a claim under an excessive loss reinsurance agreement. The ceding insurer reports a total loss of $600,000 with the excessive loss attachment point set at $200,000. If the maximum limit of the reinsurance is $400,000, how much will the reinsurer pay? A. $200,000. B. $300,000. C. $400,000. D. $600,000. Answer B. Explanation. Under an excessive loss reinsurance agreement, the reinsurer is only liable for losses that exceed the attachment point, which in this case is $200,000. The total loss reported is $600,000. The reinsurer will cover the amount exceeding the attachment point, i.e. $600,000. $200,000 equals $400,000. However, the maximum coverage limit for the reinsurer is $400,000, so the reinsurer will pay out the full $400,000. This type of agreement provides protection to the ceding insurer against very large catastrophic losses while limiting the reinsurer's exposure to a defined maximum. Question 8. Which of the following best describes a quota share reinsurance arrangement? A. The ceding insurer cedes a fixed percentage of both premiums and losses to the reinsurer regardless of the risk involved. B. The reinsurer agrees to cover only the most catastrophic risks exceeding a set threshold. C. The ceding insurer retains all premiums but transfers specific types of claims to the reinsurer. D. The reinsurer assumes all claims beyond a fixed sum for each individual policyholder. Answer A. Explanation. A quota share reinsurance agreement is a proportional reinsurance arrangement where the ceding insurer agrees to cede a fixed percentage of both premiums and losses to the reinsurer. This agreement helps the ceding insurer spread its risk by transferring a portion of the liabilities to the reinsurer. It is commonly used to reduce the ceding insurer's exposure to large claims while providing the reinsurer with a proportional of the premiums. The fixed percentage applies uniformly across the entire portfolio, regardless of the specific risk associated with the individual policies. Question 9. Which of the following factors is not typically considered when determining the pricing of reinsurance agreements? A. The past loss experience of the ceding insurer. B. The volatility of the reinsurer's financial position. C. The level of the ceding insurer's capitalization. D. The risk exposure of the reinsurance market as a whole. Answer: D. Explanation. The pricing of reinsurance agreements is primarily influenced by factors directly related to the ceding insurer and the reinsurer's ability to assess and manage risk. Past loss experience of the ceding insurer, the reinsurer's financial position, and the ceding insurer's level of capitalization are all critical in determining the reinsurance premium. However, the overall risk exposure of the reinsurance market does not directly influence the pricing of individual reinsurance contracts, although it may have more indirect effect based on broader market conditions, e.g., soft or hard market cycles. Question 10. Mr. Blake is reviewing the financial statements of a reinsurer. One item in the balance sheet is labeled reinsurance recoverables. Which of the following best explains this term? A. It represents the amount of premiums owed to the reinsurer by the ceding insurer. B. It represents the amount of claims the reinsurer expects to recover from retrocessionaires or other reinsurers. C. It represents the amount the reinsurer is required to pay out to the ceding insurer in the event of a claim. D. It represents the total reserves set aside by the reinsurer for future claims payments. Answer: B. Explanation. Reinsurance recoverables refers to the amounts that a reinsurer expects to recover from retrocessionaires or other reinsurers under reinsurance agreements. These recoverables are an asset on the reinsurer's balance sheet as they represent amounts due to the reinsurer for claims that have been ceded to other reinsurers. The term helps track the financial impact of reinsurance transactions and the reinsurer's ability to funds from retrocession agreements. Question 11. Which of the following best describes the key difference between facultative reinsurance and treaty reinsurance? A. Facultative reinsurance covers individual risks, while treaty reinsurance covers a portfolio of risks. B. Facultative reinsurance applies to proportional risks, while treaty reinsurance applies to non-proportional risks. C. Facultative reinsurance is automatically applied to all risks, while treaty reinsurance requires specific negotiation. D. Facultative reinsurance is primarily used for catastrophic risks, while reinsurance is used for smaller claims. Answer: A. Explanation. The key distinction between facultative and treaty reinsurance is that facultative reinsurance covers individual risks, while treaty reinsurance covers a broader portfolio of risks. In facultative reinsurance, the ceding insurer and the reinsurer negotiate coverage on a case-by-case basis for specific risks, typically for high-value or unique exposures. In contrast, treaty reinsurance is an ongoing agreement, covers a set of risks or policies, and the reinsurer automatically accepts the risks within the scope of the treaty without the need for individual negotiations for each risk. Question 12. Which of the following is a primary objective of reinsurance in risk management? A. To eliminate all risks from the insurance company's balance sheet. B. To stabilize the insurance company's financial position by spreading risk. C. To increase the premiums charged to policyholders. D. To restrict the insurer's coverage options. Answer: B. Explanation. One of the primary objectives of reinsurance in risk management is to stabilize the insurer's financial position by spreading the risk. By ceding portion of its risk to reinsurer, the insurer reduces its exposure to large claims and catastrophic events, thus preventing significant financial strain. This allows the insurer to maintain solvency and continue operations even in the face of substantial losses. Reinsurance does not eliminate risks, but rather helps in managing and distributing them more effectively. Question 13. Mr. Turner works for an insurance company that is using an excess of loss reinsurance treaty. The company's loss for a particular event is $1 million, and the attachment point of the treaty is set at $500,000. If the reinsurer's limit is $350,000, how much will the reinsurer pay? A. $500,000. B. $350,000. C. $1 million. D. $200,000. Answer: B. Explanation. Under excessive loss reinsurance, the reinsurer only covers losses that exceed the attachment point. In this scenario, the loss is $1 million and the attachment point is $500,000. The reinsurer will cover the amount over the attachment point, i.e., $1 million. $500,000 equals $500,000. However, the reinsurer's maximum limit is $350,000, so the reinsurer will pay $350,000, which is the limit of the coverage. Question 14. Which of the following reinsurance types involves a fixed percentage of both premiums and losses being ceded to the reinsurer? A. Excessive loss reinsurance. B. Quota share reinsurance. C. Surplus share reinsurance. D. Facultative reinsurance. Answer: B. Explanation. Quota share reinsurance is a type of proportional reinsurance where the ceding insurer and the reinsurer agree to share a fixed percentage of both premiums and losses. This arrangement helps the ceding insurer spread risk across a larger pool while ensuring that the reinsurer receives a proportional share of both the premiums collected and the losses incurred. The ceding insurer retains the balance of both premiums and losses. Arrangement contrasts with non-proportional reinsurance, where the reinsurer only covers losses exceeding a specific threshold. Question 15. In a reinsurance arrangement, what is the purpose of reinsurer's participation clause? A. To limit the reinsurer's exposure to certain types of claims. B. To outline how claims are allocated between the ceding insurer and the reinsurer. C. To specify the percentage of premiums the reinsurer is entitled to receive. D. To detail the financial statements required from the ceding insurer. Answer: B. Explanation of reinsurer's participation clause is designed to outline how claims will be allocated between the ceding insurer and the reinsurer. This clause specifies the proportion of each claim that the reinsurer is responsible for paying based on the terms of the reinsurance agreement. It ensures that both parties have clear expectations about their respective financial responsibilities in the event of a claim. Such clauses are particularly important in proportional reinsurance agreements where the reinsurer's participation is based on fixed percentage of premiums and losses. Question 16. Mr. Wilson is reviewing a reinsurance contract with a high limit for catastrophic coverage. What is the primary reason for the existence of such a high limit in a reinsurance treaty? A. To ensure the reinsurer can cover all types of claims, regardless of size. B. To protect the ceding insurer from the financial burden of extreme, low-frequency losses. C. To limit the reinsurer's exposure to only high-frequency, low-severity claims. D. To allow the ceding insurer to receive higher premiums from policyholders. Answer: B. Explanation. High limits for catastrophic coverage in reinsurance treaties are primarily designed to protect the ceding insurer from extreme, low-frequency losses that could threaten the insurer's solvency. These catastrophic events are often unpredictable and can result in enormous financial losses, such as natural disasters. By securing reinsurance with high limits, the ceding insurer can ensure that it has the financial backing necessary to from these catastrophic losses without jeopardizing its overall financial stability. Question 17. Which of the following is a typical characteristic of structured reinsurance? A. It involves the simple transfer of risk based on premiums and losses. B. It is typically used for standard insurance policies with minimal complexity. C. It is designed to address complex and large-scale risks with tailored solutions. D. It is primarily concerned with covering small, frequent losses. Answer: C. Explanation. Structured reinsurance is designed to address complex and large-scale risks by providing tailored solutions. These arrangements often involve intricate financial structures, such as finite risk reinsurance or other forms of customized coverage. Structured reinsurance is used when traditional reinsurance methods, like quota share or excessive loss, are insufficient to manage highly complex or high-value risks. It often involves negotiation of specific terms, including limits, layers, and trigger events, to best fit the needs of the insurer. Question 18. Which of the following best describes a finite risk reinsurance arrangement? A. It involves the reinsurer assuming an unlimited share of the ceding insurer's risk. B. It provides coverage for risks that have predictable and finite cost. C. It involves the transfer of fixed amount of premiums with no loss recovery. D. It involves reinsurance agreements designed for high-frequency, low-severity risks. Answer: B. Explanation. Finite risk reinsurance is a form of reinsurance designed for risks that have a predictable and finite cost. Unlike traditional reinsurance, which is primarily concerned with covering catastrophic events or large losses, finite risk reinsurance involves agreements where the reinsurer's liability is limited and the ceding insurer retains portion of the risk. The premiums paid for finite risk reinsurance cover the expected losses and some margin, but do not extend to catastrophic or extreme risks. This arrangement allows insurers to manage their capital more efficiently while still providing coverage for predictable risks. Question 19. Mr. Johnson is involved in a dispute regarding a reinsurance claim. The reinsurer argues that the ceding insurer did not comply with the proper claims reporting procedures. What is the typical consequence if an insurer fails to adhere to claims reporting procedures in a reinsurance agreement? A. The reinsurer may refuse to pay a claim or reduce the amount paid. B. The insurer must pay a penalty to the reinsurer for non-compliance. C. The reinsurer will automatically pay the full claim regardless of reporting procedures. D. The claim will be automatically transferred to a retrocessionaire for settlement. Answer A. Explanation. If the ceding insurer fails to adhere to the proper claims reporting procedures outlined in the reinsurance agreement, the reinsurer may refuse to pay the claim or may reduce the amount paid. These procedures are essential for the reinsurer to assess the validity of the claim and determine the appropriate amount of coverage. Failure to follow reporting procedures can result in delays, misunderstandings, or disputes, which may lead to partial or complete denial of the claim. Question 20. What is the primary reason reinsurers use catastrophe models in pricing reinsurance agreements? A. To estimate the cost of claims based on historical loss data. B. To predict future loss events and determine the pricing based on exposure to natural disasters. C. To calculate the exact amount of capital needed to cover reinsurance premiums. D. To evaluate the claims handling capacity of the ceding insurer. Answer. B. Explanation. Reinsurers use catastrophe models primarily to predict future loss events and determine pricing based on exposure to natural disasters and other catastrophic events. These models use historical data, scientific research, and simulations to estimate the potential financial impact of rare but extreme events such as hurricanes, earthquakes, or floods. This allows reinsurers to accurately price the risk associated catastrophic events, ensuring that they can adequately cover potential losses while maintaining financial stability. Question 21. Which of the following is the most common reason for a ceding insurer to use reinsurance? A. To transfer all of its risks to the reinsurer. B. To increase the insurer's underwriting capacity and reduce the volatility of losses. C. To increase the insurer's market share by offering low premiums. D. To comply with regulatory requirements for capital adequacy. Answer. B. Explanation. The primary reason a ceding insurer uses reinsurance is to increase its underwriting capacity and reduce the volatility of its losses. By transferring some of the risks to a reinsurer, the insurer can take on more business while stabilizing its financial position, especially during periods of large or catastrophic losses. Reinsurance does not completely transfer all risks, and the insurer still retains a portion of the risk. Question 22. Which of the following best describes a stop-loss reinsurance arrangement? A. It provides coverage for losses exceeding a predetermined amount within a specific period. B. It covers losses resulting from a single catastrophic event, regardless of size. C. It covers a specific number of policies or a fixed percentage of premiums. D. It guarantees payment of all claims up to a set limit, after which the reinsurer assumes all losses. Answer A. Explanation. A stop-loss reinsurance arrangement provides coverage for losses exceeding a predetermined amount, usually within a specific time frame. It protects the ceding insurer from cumulative losses that exceed a certain threshold, ensuring that the insurer does not suffer financially if the total claims in a given period exceed expectations. Stop-loss reinsurance is often used to manage volatility in claims experience. Question 23. Under surplus share reinsurance treaty, which of the following is true? A. The reinsurer accepts all risks in exchange for a fixed percentage of the premiums. B. The ceding insurer retains a fixed portion of each risk and the remainder is shared with the reinsurer. C. The reinsurer only accepts risks with a very high probability of loss. D. The ceding insurer pays the reinsurer a fixed amount regardless of losses. Answer B. Explanation. In a surplus share reinsurance treaty, the ceding insurer retains a fixed portion of each risk while the remaining portion is shared with the reinsurer. This type of reinsurance is typically used for high-value risks where the ceding insurer may not want to assume the full exposure. The reinsurer's share of the risk is proportional to the amount of surplus capacity it provides. Question 24. What is the purpose of retrocession in the reinsurance market? A. To transfer the risks of one reinsurer to another reinsurer. B. To allow the ceding insurer to retain more risk. C. To enable reinsurers to avoid catastrophic losses by limiting their exposure. D. To increase the ceding insurer's total underwriting capacity. Answer A. Explanation. A retrocession is the process by which a reinsurer transfers some or all of the risks it has assumed from a ceding insurer to another reinsurer, called the retrocessionaire. This is done to manage the reinsurer's exposure to large or catastrophic risks and to spread the risk further across the reinsurance market. Question 25. Which of the following is an example of A non-proportional reinsurance agreement. A quota share reinsurance. B. Surplus share reinsurance. C. Excessive loss reinsurance. D. Facultative reinsurance. Answer C. Explanation. Excessive loss reinsurance is an example of non-proportional reinsurance. In this type of arrangement, the reinsurer covers losses that exceed a certain predetermined amount, but it does not share in the underlying premiums or losses in a proportional manner. The reinsurer is only liable for losses that exceed the ceding insurer's retention level, the threshold making this non-proportional agreement. Question 26 in reinsurance. What does the term cession refer to? A. The process of transferring risk from one insurance company to her reinsurer. B. The total amount of risk her reinsurer is willing to assume. C. The premium paid by the ceding insurer to the reinsurer. D. The amount of loss retained by the ceding insurer. Answer A. Explanation. The cession refers to the process of transferring risk from the ceding insurer to the reinsurer. The ceding insurer transfers a portion of the risks it has assumed to the reinsurer in exchange for a reinsurance premium. This helps the ceding insurer reduce its exposure to large losses while maintaining its financial stability. Question 27. What is one of the key advantages of a quota share reinsurance arrangement? A. It allows the ceding insurer to retain all risk while obtaining a small portion of the premiums. B. It provides a way for the reinsurer to gain control over underwriting decisions. C. It helps to stabilize the ceding insurer's cash flow by providing a proportional sharing of premiums and losses. D. It enables the ceding insurer to exclude certain risks from the reinsurance agreement. Answer C. Explanation. One of the key advantages of a quota share reinsurance arrangement is that it helps to stabilize the ceding insurer's cash flow by providing a proportional sharing of premiums and losses. Both the ceding insurer and the reinsurer agree to share a fixed percentage of premiums and losses, which helps distribute the financial impact of claims more evenly. Question 28. In a reinsurance contract, which of the following is typically the responsibility of the ceding insurer? A. To collect the premiums from policyholders and transfer a portion to the reinsurer. B. To pay the reinsurer a fixed commission for handling claims. C. To manage and settle claims, often with reimbursement from the reinsurer. D. To assume the total risk of any catastrophic event. Answer C. Explanation. In a reinsurance contract, the ceding insurer typically manages and settles claims, often with reimbursement from the reinsurer. The reinsurer reimburses the ceding insurer according to the terms of the reinsurance agreement, which may involve covering all or part of the claim amounts that exceed certain thresholds. Question 29. Which of the following types of reinsurance allows the ceding insurer to select individual policies to reinsure? A. Treaty reinsurance. B. Facultative reinsurance. C. Quota share reinsurance. D. Excessive loss reinsurance. Answer B. Explanation. Facultative reinsurance allows the ceding insurer to select individual policies or risks to reinsure. This is in contrast to treaty reinsurance, where the reinsurer automatically accepts a portfolio of risks. Facultative reinsurance is often used for large, complex, or unusual risks that are not included in a standard treaty agreement. Question 30. Under which of the following conditions is reinsurance most likely to be used by an insurer? A. When the insurer is looking to increase its exposure to high-risk policies. B. When the insurer wants to reduce its capital requirements and manage risk more efficiently. C. When the insurer aims to reduce its policyholder premiums to attract more customers. D. When the insurer seeks to avoid paying claims altogether. Answer B. Explanation. Reinsurance is most often used by insurers when they want to reduce their capital requirements and manage risk more efficiently. By ceding part of their risk to a reinsurer, insurers can protect themselves from large or catastrophic losses and free up capital for other uses. Reinsurance allows them to take on more policies while maintaining a manageable level of risk exposure.